Welcome, everybody. Thanks for everybody who's listening. Make sure that you are following Dcentral, and I'm really excited for this fantastic panel. We're going to be talking about stablecoins, and we're going to talk about it from every which angle you can think of. Everything from the centralized to the decentralized to CBDCs to in-network type of things. The good, the bad, and people's outlook. So. Before we get started, I'll just do a super quick intro on myself. My name is Jonathan G. Blanco. I am a founder in the Web3 space and have been in this space since 2017, focusing on the intersection of commerce and crypto. My latest startup is called Niftmint, where we're building NFT infrastructure for brands. And I find stablecoins particularly fascinating. Is that something that we intend to incorporate at some point in the future? But we don't think the brands are 100% ready for it just yet. But we'll see, and I'm excited to hear what these amazing folks have to say. So I'm just going to make it easy and have you all introduce yourselves in the order that I see you. So I'll go with Carter first, if you could just introduce yourself to everybody, and then we'll go along the line, Stefan, Sean, and Sam, and we'll get right into the conversation.
Yeah, thank you so much, Jonathan. So Carter Woetzel here, been in the space for 5 years. Spent 3 years researching and writing a book. Really passionate about privacy technology and how it intersects with the consumer side of things, just because blockchain today has been completely transparent, and the barriers of entry that's going to introduce with bridging Web3 to Web2, specifically as it pertains to stablecoins. So one of the lead researchers for Shade Protocol, we're launching a privacy-preserving stablecoin called Silk, pegged to a basket of global currencies and commodities. So that's a little bit about me, and huge fan of all the other founders on these calls. So this is a great group we have here.
Great. Well, thanks for having you. Thanks for being here with us. Stefan, off to you.
Thanks, Sean. Hey, everybody. Nice to be here. Stefan, founder of Truflation.com, and we're just in the process of launching a flat coin. And what is a flat coin? Basically, it's a stable coin pegged to a basket of consumer items. And that's what we're launching. Been in Bitcoin since 2012, former CEO of Bitcoin.com. And we've assembled a great team. And what we're looking to build out is, getting to a non-decentralized, crypto-backed, sort of flat coin.
Awesome. I'm excited to dig deeper into that. Sean, over to you.
Great. Thanks, Jonathan. Hi, everyone. My name is Sean Bennett. I'm co-founder and CTO at Stronghold. We're a fintech based in San Francisco that is bridging the traditional world where most of the transaction volume is today with the possibilities and features that the blockchain and decentralized worlds can offer. We're a little bit quieter in the DeFi space. You may not have heard of us, but recently we were named on the Forbes FinTech 50 list alongside other key players in the Web3 space like FTX and OpenSea.
Nice. Thanks, Sean. And last but not least, Sam, if you can introduce yourself.
Yes. Hey, everyone. This is Sam. I'm the founder of FRAX Finance. FRAX is a fractional stablecoin, as we like to call it, which is partly algorithmic and partly backed by hard assets like other stablecoins, over collateralized loans, and the like. And it has a dynamic collateral ratio. FRAX has grown really big since its launch. It's actually the number 5th largest stablecoin and the 2nd largest decentralized one after DAI, just around 1.5 billion in circulation. And the protocol is actually quite profitable and huge. I think currently, even in these markets, it makes about 80 million of revenue. And the team and the DAO is pretty lean. There's only 8 full-time core developers. Things are going quite well. We're building out an entire economy around this, and we've actually recently launched our second stablecoin of the FRAX ecosystem called the FRAX Price Index. As Stefan probably knows, it is also a type of flat coin. It's essentially the first stablecoin pegged to the consumer price index or basket of consumer items. So FRAX is officially kind of an ecosystem rather than just a sole stablecoin. So we've been doing a lot of things recently. Yeah.
Awesome. Well, thank you, Sam. Thanks for joining us as well. So before we get started, if you are watching, I always love to do this. Do us a favor and comment, because we get to see it on our side too. just comment where you're watching from real quick. What city are you in? Where are you at? Throw that in there. And then also do make sure to give these amazing speakers a follow. If you screenshot this event and tweet it out, tag them, and we'll make sure that we retweet it. Of course, tag Dcentral as well. So look, most of us who are on this call watching right now know what a stable coin is, but let's just do a quick level set. We don't need everybody to answer. Who wants to just level set real quick? What is a stable coin? And then we'll get right into some of these variation types of stable coins and different ways you all are going about it.
Yeah, I mean, I don't know. I'll go if nobody else is going. Yeah, I mean, basically a stablecoin, in my view, the stablecoin actually brought about an amazing user experience into the crypto world, right? I think the user UX of providing stability around a payment mechanism and a reference of which somebody can then relate to, generally the general users can relate to a currency, is what represents a stablecoin. What is the UX? It's basically pegged generally to a fiat coin, and so its stability is there. Ultimately, making sure that you don't pay $300 million for pizza.
Nice. Everybody agree with that definition? Anybody want to add to that?
I think that the other great thing that it provides people is a very easy entry point into the ecosystem, right? You can interact with DeFi contracts and never leave traditional currencies that you know and love, right? And then you can start tipping your toes into those other, crypto assets that might exist out there. And the other big thing that brings is it's a major flow of funds on and off chain. So people don't have to exchange directly at, the point of centralized exchanges anymore. You can, on ramp into the network and then, bring the money straight on. So I think that's the other important thing it brings.
Add more too that says that stablecoins ultimately are liabilities that have to be accounted for because they're the promise to redeem at some point for a certain amount of value, and that's the stuff that keeps every stablecoin project up at night.
Nice. Okay, so with that, I'm going to ask questions that I think maybe audience might be thinking about and so forth. So. Why do we even need a stablecoin? Can't we just use, a digital ledger? Like, can't I just measure this, in my own database or have a loyalty point instead? Why do we need stablecoins to begin with?
I mean, I can jump in here and say that ultimately, I'm guessing those reward points are probably going to be volatile and speculative. You need economic levers that can keep it at a stable price point that's referenced to something like a sovereign currency or something like inflation in the case of Nuon. And so ultimately it's about stability. And at the point that you've designed levers to keep something at a stable price, then congratulations, you're at a stable coin. So, and we need that for consumers to be able to transact with each other for the settlement layer in Web 2 and in Web 3.
Yeah, someone break that down for us about settlement layers and why that matters, and what you just mentioned there, Carter, about essentially pegging those together so it doesn't offset and derail.
I think Sean's probably in a good position to answer that just because he sits at the crossroads of more of the Web 2 world. I'd love to hear his answer on this.
Absolutely. Thinking about those settlement layers, for us at Stronghold, we've always been about building virtual payment networks for businesses. So that means we've very much been in the game of building fully collateralized one-to-one backed stablecoins. So for us, we've always been that sort of on and on ramp provider between, the normal banking system, thinking about domestic US or, ACH and wire systems to that on-chain settlement. It's important for us to have eyes on all of the participants and whitelist participants. The reverse of that means that the participants are also very, very stringent about where the money's kept at any particular time. So for us in that bespoke world, they were able to trust settlement on chain because they absolutely knew where the underlying funds was. they had access to, communicate with the bank that held the funds even. Even though settlement had to happen at the banking layer, at the end of the day, obviously, you have to rebalance outside the system for that type of stablecoin. They were able to trust settlement on chain for as good as fiat. But I don't think that scenario holds true for most other use cases that we see out there. That was a very specific deployment that we did.
I mean, if you look at stablecoins and you look at, I think stablecoins have now evolved, particularly, to be the backbone of DeFi. If you look at the growth of stablecoins, I mean, Tether's been around for, since 2015 or something, really long. However, the real growth kicked in when, the DeFi summer broke off, right? If you look at the growth of stablecoins in terms of the total market cap, and I think Sam was right at the time around 2020 when you launched FRAX, right? But when that sort of kicked off, it's gone from, I don't know, some sort of a couple of $100 million market cap to now all of a sudden we're above 150 billion in market cap across all stablecoins. I think the interesting element around, I think what most of us here are working on is sort of trying to build out a decentralized nature to match the decentralized finance, build a decentralized stablecoin, because that growth in stablecoins has largely been mapped out by 3 centralized stablecoins that now earn about 92% of that growth. Why? Because in DeFi, they've created liquidity pairs for trading. And so I think that's where a lot of the growth has come from in stablecoins. And if you look at the overall money market, it's still a couple of $100 trillion, $60 trillion or something. I was seeing a number somewhere. I'm not sure, don't quote me on that, but there's still a lot of room for money to be used. And by the way, a lot of the stablecoins today are used in DeFi, and very little is used in peer-to-peer transfers, and very little is used in commerce.
Yeah, I'd love to break that down more, because it seems as though if you have a crypto context or crypto frame of mind, what you say, clearly is understood, right? For those who might not be in the space, or I feel as though like when you hear about stablecoins talked about more in a mass market context, they are spoken of in like a commercial setting or a peer-to-peer context. So is there going to be growth moving into that sector, or is that more just marketing on that side, and this stablecoins will primarily stay in a crypto trading or crypto or in a DeFi type of scenario? What does that look like? And Stefan or Sam or jumping in.
I mean, I don't know. I mean, I think at the moment, DeFi is still, I don't know, how big is the whole, if you look at all TVL across DeFi, it's about 150 billion TVL. That's come down significantly over the last couple of months, if you will. But we see that actually growing to $9 trillion, right? So there's going to be 9 trillion across the DeFi protocols that are out there. And that's not even tapping into the size of gold, right? Gold is about an $11 trillion market cap. And so is that realistic to hit 9 trillion in TVL, given all the capabilities and functionalities that we can see in decentralized finance, synthetic assets that are going to go on chain, security tokens that are going, the whole NFT industry, sort of, there's so many different types and permutations of what can be brought on chain and locked up in these different blockchains and smart contracts. How do they get interacted with? What are their liquidity pairings going to look like? Just alone in DeFi, that's the size of growth. Commerce, I think if you look at inflation breaking out around the world, look what's happening in Sri Lanka, look what's happening in Turkey, in Argentina, in Amsterdam, because the price of food is going up so high, because the lack of supply chain is driving up food, the lack of efficient supply chains is driving up the price of the lack of supply of food onto the shelves, driving up demand, not meeting the demand, driving up the price. What is that resulting in? Unrest. how do you then transact? How do you you're losing faith in the local currencies? In crypto land, 99% of the currency we live with is US dollar, right? I mean, crypto land just works in US dollars. I think you look at all stable coins, they're all traded in US dollars. So US dollar is the global currency, and crypto land is a representation of a global community. And as a result, US dollar matters. And around the world, if you're paid in a stable coin, I think no matter what country you're in, you're super happy because you've at least got somewhat of a hedge against, I was just talking to somebody in Argentina, 60%, inflation in Argentina. In Venezuela, I think they have 20% day on day inflation rate. You have in Turkey, you have another 80% inflation rate. No, 200% inflation rate, sorry. So you just got all these different percentages that is losing in value. So my purchasing power is being diminished. Where and how can a stable coin come in and help replace and retain my purchasing power? And that's where FRAX and with their FPI is super innovative, and we're just trying to take it a tweak, give it a bit of a tweak, where we're offering it tied to Truflation, which we believe is the actual inflation happening. And so I think there's a number of innovations trying to come, and how do we redefine what purchasing power is, and what the purpose of money really was really to facilitate trade, facilitate commerce, and provide a form of value that can be used to accelerate global trade or trade on a peer-to-peer basis.
Yeah, on the commerce side, it's
I want to say basically one of the things I always say is the stable coins and crypto are kind of the $3 trillion category of the industry. And I'm very confident in saying that, with the first two being Bitcoin and Ethereum. And just as those two assets have really important total addressable markets in the trillions, I really think that stable coins are the third and currently only other category as being multi-trillion in the next 5 years, 10 years. And like Stefan was saying, the most important thing eventually is basically having a on-chain token that has stable purchasing power to things that we find useful, right? And humans find things useful like baskets of consumer items, medical care, electricity, oil, food, shelter, right? All of these things are what the US dollar at least tries to track, right? And so right now, most of stablecoins are pegged to the US dollar, but as Stefan's working on, and us at FRAX are working on with the FPI, there's a next generation of stablecoins that should hopefully be able to provide a crypto asset that is actually inflation resistant, in the sense that it keeps its purchasing power to a important set of items, so people can actually conduct savings and do these things on chain in a sound manner, right? And then the other thing is that obviously there's going to have to be ways in which this stability is actually connected to the real world. There's not ever going to be any way that you can collateralize, a token that basically keeps up with real world items without being able to tap into real world collateral in some way, right? I mean, that just, it doesn't even make sense, right? If you want to have a cryptocurrency that actually is scalable and able to keep up with the price of oil, food, shelter, and all these things, you need to be able to issue debt, collateralize, and basically have some kind of anchor to real world economic activity that's producing those things, right? I mean, NFTs don't produce those things, or nor does AMM, yield or something like that. Those are very volatile, unpredictable in aggregate, right? In aggregate, you need to actually hook into real world economic activity that's creating these things, and then actually peg your stablecoin to the credit creation and debt that's actually collateralizing those kinds of economic activity. So those things will take a couple of years, but it's really cool to see there's people working on it with us and with FRAX and Stefan and all the things you guys are doing in your respective projects.
Yeah, the final piece of the puzzle you have correlated, uncorrelated, and inverse correlated assets, right? And like crypto to date has been correlated assets backing correlated assets, right? And once we can get inverse correlation and uncorrelated assets tied to like representations on the blockchain and the ability to back stable assets with that, we're going to unlock a whole host of value and adoption and scalability on the stablecoin front. So it's an interesting challenge problem, and I know people are obviously working on it. It's a hard one to solve.
You're on mute, Jonathan.
Hey, sorry about that. Yeah, no, I think it's super fascinating how you're all breaking this down. And, you know, when I think about you know, this whole flat notion overall, like, is there a scenario where a stable coin, call it protocol or methodology, wins out, or is there room for different types of stablecoin, right? So we saw, of course, algorithmic stablecoins, you know, take a big hit a few months ago or a couple months ago. You know, there's centralized, decentralized. We're talking about flat as well. Is there a need for multiple types of stablecoins, or do you all believe that everything will gravitate towards one particular, you know, type of stablecoin?
Power law distribution so far has been about 20% of stablecoin projects succeed. There's like a couple in the middle range, and then like the other 80% don't. So it seems like it's definitely a competitive space, and you live or die by liquidity. But in terms of the necessity for multiple decentralized stablecoins, absolutely. If all blockchains only have one decentralized stablecoin and those economic levers broke, whether it be, you know, from some part of the tech stack or some part of the economics broke, then the contagion from that is terrible. So like for sure we want to diversify the stable coins, and honestly, like the more different models we can have, the more diversification of models, the better it is for the space, versus like having 10 stable coins that all have the same tried and true trusted model. So we need to continue to experiment on the model front for true diversity.
Yeah, I mean, I think the growth of the, you know, the UST, how rapidly that grew, I think was just a, you know, a sign that there is demand for alternative stablecoins, right? I mean, the market is asking for something slightly different, and yeah, I think there's a big gap to be filled out there. You know, I think these, you know, like I mentioned right earlier on, 92% of stablecoin industry is dominated by 3 different coins. They're centralized. You know, at some point, regulation's going to start impacting these centralized institutions. They're all, yeah, and in our view, they're then pegged to the US dollar. Okay, then again, the same people that are regulating that are also then driving the policies associated with a stable coin. So that's why sort of, I think, you know, sort of we're looking for alternative sort of pegs that we can create. What do they look like? We're creating privacy-based coins. You know, so there's some really interesting different types of models. How do they get bigger traction in the marketplace is really availability and trust, right? Transparency. How do we make visible all of the transparency associated with it, right? So we're sort of trying to make it cryptographically verifiable. What are the reserves that are there? So at any point in time, you can go and see that it's verified by a third party. You're just trying to build trust so that people can start using it, can start holding it longer, and not have it sort of lose and depeg and lose all of its value in a rapid period of time.
Absolutely. And following on from what Stefan was talking about at the end there, it's going to come down to the different use cases that you actually want to use these stable coins for, at least in the short and medium term, right? Thinking about, you know, those centralized coins getting more regulation, more trust. Hopefully we see that transparency. That gives businesses and consumers guide rails, right? I understand now that this particular stable coin in this particular jurisdiction is going to work like this. Great. Banks will start adopting it. They'll be integrating into their payment systems. They'll feel comfortable doing that. Therefore, the businesses will be able to start using them and be able to push them down to the consumer, whether they realize that that's what's under the hood or not. There's going to be other scenarios when you want that decentralized control. Accessibility for global markets comes to mind, underbanked comes to mind. So I think that we are going to see these different models sort of aligning themselves with the different use cases outside of, strictly DeFi.
That's super well put. I think it's interesting because to have truly peer-to-peer transaction, like the original vision of crypto in many ways is like a true peer-to-peer transaction on the stablecoin front. But in order to bridge back to everyday life right now, like a lot of crypto is forced to bridge back through like fintech and through like those Web2 rails. And so I think like one of the key variables is privacy. Like you need a degree of consumer privacy in order to have truly peer-to-peer transactions for merchants and for institutions. And so, yeah, I totally agree with you. I just think like there's little different like verticals and emphases that's going to emerge, and like stable coins will be more aligned with, different sets of use cases. Yeah.
Nice. And so, so with it, we've kind of touched on this a little bit. So I'd love to just break down real quick this notion of a decentralized stablecoin versus a centralized stablecoin. I think call it people that might be more Bitcoin or Ethereum maximalists might think of stablecoins strictly from a centralized point of view. And I've learned from a couple of you in the past that hey, actually there's some decentralized elements. I'd love if one of you can break that down and think through that for us.
I would say that, so your centralized stablecoins, there's obviously like a real world entity, the bank account that's kind of promising to handle redemption back and forth in the system, and they make a lot of money from handling that market making, I guess, for maintaining a peg for a centralized currency. And then you have, your decentralized stablecoins that are supposed to have, different crypto assets backing the system. There's varying degrees of quality of assets, as it pertains to decentralization. Like one of the criticisms a lot of decentralized stablecoins have had is like, hey, like if you're a stablecoin that's just backed by USDC, like, are you really like a decentralized stablecoin? So it's kind of, we need to continue to push the boundaries of making truly decentralized stablecoins, and then those ones will be building blocks for other decentralized stablecoins. But it's like, what's at the base of it? It's collateral that isn't centralized ultimately, and it's collateral with a lot of liquidity. It's collateral that doesn't have a lot of compressed volatility, that has minimal smart contract risk, bridge risk, whatever have you. So we still have a long ways to go on that front. And that's just because the markets that are defining these assets that are supposedly decentralized are still very, very young, and there's a lot of maturing that has to be done on that front.
And then in that front, so like if the assets are decentralized, is the entity itself going to be decentralized? Meaning, like, are these like operating in like some sort of DAO-like structures, or are these centralized entities operating, decentralized pegging systems? And then does that matter? Does that still equate to being decentralized?
I'd love to hear Sam's opinion on like the impact of DAOs on what we consider decentralized stablecoins. It's actually it's an interesting question.
Yeah, I mean, there's two ways that I see this kind of decentralization. I think usually it's not well appreciated in like the wider crypto or use case economy of stablecoins. One is it actually a bearer asset? And most custodial based stablecoins that have a fiat or traditional financial asset backing, they are not, right? So you could, in theory, wake up one day and have your wallet blacklisted. Usually you won't, obviously, if there's no specific reason, but the idea is that it does not belong to you, right? And so you can actually be prevented from actually transferring that asset. And certain of them, they can actually change the balance of the stablecoin in your wallet. Most of them can freeze it from a function. So that's one thing, is that if it's an actual custodial asset, for example, FRAX is entirely non-custodial. It means that there's absolutely no way for the FRAX protocol or smart contracts to blacklist or change anyone's balances. Same thing with DAI. No one can get their DAI blacklisted or frozen. So that's one half of it. And so that's extremely important in and of itself, even if, for example, MakerDAO or FRAX has real world lending or assets, like I was alluding to, like hooks into the real economy. The actual stablecoin itself is non-custodial. If you own it, you actually own it. It's like owning cash. And so that's the first part. And the second part, like Carter was saying, and you guys were talking about, is there an actual danger of risk to the assets being claims about things in the real world? Because then you need courts and traditional financial and legal systems for enforcement, for being able to actually liquidate those assets and conduct that part of the protocol or the DAO's monetary policy. And those, I think that gets a little bit murkier because, like I said, I think in the grand scheme of things, if stablecoins are going to be multi-trillion-dollar sectors in crypto, they will have to hook in some way to the actual real physical economy, and that's where actual physical meat space, legal regulations and different jurisdictional rules apply to some parts of the asset of these DAOs, whether it's FRAX or MakerDAO and these things. But I think it's important to highlight there's two parts to the kind of decentralization definition, because it's kind of a very vague thing. And the most important from a user perspective is, do you actually own the actual stablecoin token? And there's obviously a wide range of things, like DAI and FRAX you do, but other fiat coins you don't.
And Jonathan's gone, so we're the hosts. I'll pose a question to the group then. What do we think is the biggest challenge for stablecoins in terms of competing with the likes of like USDC and USDT in the coming years?
I mean, I think it's going to be interesting. I usually don't think that there's actually a lot of zero-sum competition in stablecoins. The previous question a few back was that, is there going to be just some or a lot? I think as long as stablecoin projects are positive sum and are building liquidity against each other in curve pools or stable swap pools or concentrated liquidity on chain, they're essentially increasing the resiliency of their own pegs, right? And so technically what MakerDAO is doing, and partially FRAX has some smaller amount of exposure to USDC and fiat coins as well, is that our pegs are positive sum, right? They actually benefit from the stability of something like USDC, which has a link to US Treasuries. Right now, Circle holds almost all US Treasuries. There's no way for anything on chain to actually access the stability of US Treasuries, which are essentially cash equivalents, right? And so the only way, the closest thing we can do to tap into that is to have some amount of, USDC in a manageable risk assessed perspective. And so as long as stable coins are integrating each other in like a reasonable way, right? And so, one implosion or depeg doesn't affect the actual other stablecoin project, but they're building liquidity overall. I think that is the key to basically making a really vibrant and many stablecoin ecosystem flourish.
Yeah, I mean, I totally agree what Sam said, both earlier and now, right? I mean, in essence, what has happened is, when in a centralized coin, I can shut it down. Jurisdictions can come in and close you down. Where do I go? How do I manage that? But I do think the growth, and we talked about the growth numbers earlier, and I just think they're going to prove out a large opportunity for many different experiments out there. The way, and I think from a decentralized nature, the way that we can continuously prove our reserves, our status and health is by transparency, right? That's how I feel that the decentralized coins are really going to prove their worth. I don't need a Ernst & Young attestation to show that I have the reserve. and or another sort of big consulting firm to get that attestation, right? We can actually go onto an Explorer. I can then look at the wallets. I can see I can have a cryptographically verified proof of reserve, so you can have all of these elements live, active, in real time, with using modern architecture, right? I don't need an accountant and auditor to go in there. I think we're better than that. And I think we are here working on building a better than that type solution.
I think that one of the key pieces for, which stablecoin will end up winning, or is it going to be multiple, is how each of them interact with the traditional infrastructure. Again, I'm going short, medium term, not 50 years plus. But, the reality is today that customers and businesses want to interact with things in not too a dissimilar way that they are now. And the players that are doing the best at that are your centralized stablecoins. They are much more accessible. Not even talking just about liquidity, but just API accessibility, banking systems plugged into the US banks that you can access today. That's really important for who's going to win short to medium term. I think that when regulation starts increasing, and it'll be interesting to see what CBDCs do, it will be very hard to convince a bank, a business, even a small business, to use anything other than something that has, the protections, availed to them by way of regulation and the traditional banking system. Surely there'll be a lot more innovation happening in DeFi, but, back in, where most of the money still moves today.
I like how you say protection, Sean. Sorry, I just have to smirk a little bit, right? I mean, look at Voyager. They were protected. They were FDIC insured, right? They had huge logos at the bottom. They were licensed, right? You see that across most of these CeFi solutions that came in to promise yield at no work, or leave the work to me. I will handle it for you, right? And they were. And you think about it, whilst the US dollar is the de facto cryptocurrency that we hedge and work towards, the population in the US and GDP is still the largest in the US, but how much of that is export related? You look at, the population, it's still 300 million. There's a whole world outside suffering with significant currency lags, right, and challenges in the real world, right? So will you trust a FRAX or a Nuon or Shade, or where will I go, or a Stronghold? Will I trust the coin from there, or will I trust the Venezuelan government or the Argentinian peso? I don't know, right? And I think we're still very myopic in thinking there are two countries that matter in regulation. There's China and there's the US, right? And you want either one regulator, or do you want the other regulator? I don't know, but I think there's a lot of room for alternatives.
And to be clear, I hope that we see those regulations to introduce the protection. They did not exist. What happened in the US would not be able to happen in some other countries unless they were breaking the law. So just setting that clear.
That's very well said. And another form of regulation is Solidity code, right? So there's going to be three kinds of regulation: smart contract, China, and US.
Well, guys, thank you so much. This is by far the best way to end a panel, is just with lots of alpha and lots of great conversation and discussion fire here. So, thank you so much, everybody. Please give them a thumbs up. Give them a pound sign, whatever you want to do, but show them some love in the chat. Make sure that you're following these fine gentlemen here. And I look forward to watching this conversation again. I know Dcentral will have this up on their YouTube also. So thank you all, everybody. My name is Jonathan. Happy to be with you all. And we'll see you at Dcentral Miami.